Hello, everyone, and welcome to the Buck Stops Here. I'm Catherine Murray. Well, as we know, we've seen a lot of damage in the equity markets and certainly risk assets in general. A lot of concern as it relates to the economy and the outlook for the economy. So I wanted to bring you once again a veteran, a Wall Street veteran. Barry Knapp is joining us. He is the managing partner of Ironsides Macro. Barry, great to be able to get your views and to share them with our viewers today. So thanks so much for joining us. A lot to discuss. There's no doubt about that.
Absolutely.
So Barry, let's start with, and I'm doing this a lot on the program these days, but I think it's the key driver has been for the equity markets for the past decade and continues to be. Unfortunately, it's in the opposite direction of what we've been experiencing, down. But it's the U.S. Federal Reserve. I mean, everything seems to really be reliant on what the Fed does or does not do. So what have you been talking to your institutional clients about as it relates to the U.S. Federal Reserve and what happens from here?
We have unprecedented levels of correlation across asset classes and within asset classes, which just I mentioned to underscore that point of how integral the Fed is to, what your returns are going to look like. If you start your day by looking at the dollar, a stronger dollar implies higher bond yields, lower stock prices, lower commodities, and vice versa. We've been distracted by some of the things going on in the rest of the world, but those items all can be traced back to the Federal Reserve. So, for example, after the last Fed meeting, when I thought they were going to have trouble exceeding hawkish expectations, and they were capable, they actually did that, right? The dot plot reintroduction of forward guidance, if you will, and then Chair Powell embracing that dot plot and the idea they were going to go 75 in November, 50 in December, and another 25 in January, led to chaos in exchange rate markets. The next morning, the first thing I saw was that the Japanese had intervened to the tune of $21 billion. Shortly thereafter, there was a flash crash in pound sterling. That's all been attributed to the trust government plans, but those plans were well known. And those were actually probably pretty good ideas, particularly for someone that started out in economics when supply side economics was having a real impact on capital investment back in the Reagan days. But that notwithstanding, this really has all been about the Fed. So the idea is here, we've been looking not for the so-called Fed pivot, but the inflection point when they start to slow the pace. And the analog for this is 1994. After that 75 basis point rate hike in November of 1994, we were past the point of maximum hawkishness, and the markets found relief after that. Bonds rallied, stocks rallied, and that really was the important inflection point. And so we think we're pretty close to that. We think next week, Chair Powell is likely to give a much more balanced description of the outlook, because for two reasons, really. One is because they have created global financial instability, and they recognize that. We had a couple of Lael Brainerd speeches to that effect. And then they're also increasingly concerned about the impact on the housing market and the lagged effect of policy. And we've heard that from Charlie Evans of Chicago, Mary Daly of San Francisco, and John Williams of New York. So Esther George is concerned for different reasons, but we think we have what I've been calling a developing dovish dissenters. And so that'll be really the key on Wednesday, is whether they do step down that rhetoric.
That is so interesting because, the market has just been so volatile. I don't know that mind you, it's rallying. So maybe it is actually picking up on that exact point.
I think that's right. I think we're also going through a broader transition within the markets from the pandemic rebalancing. You could see that in the GDP numbers today, and starting to move into what the trends are likely to be in the next cycle. One of the things I think you and I have talked about in the past is this idea that the benefits of the build out of the cloud, of digitization, are going to move from the producers of that technology to the consumers of that technology. And that's been on offer this week. Microsoft's weaker than expected results in the cloud. We'll see what AWS looks like tonight with the Amazon results, but the struggles of big tech relative to the old economy stuff. Jeff Curry at Goldman Sachs calls it the revenge of the old economy. And I think
I saw
that's
that.
not a bad way to think about it.